Welcome to the CFO Hive podcast. We've got David Kideckel with us here. David is a CFO, a CBO, a PhD, an MBA, and I think the list goes on and on. David, thanks so much for being here today.
Thanks for having me, David.
So, I mentioned CEO or CFO and CBO, Chief Business Officer, and we were just chatting about this. I would love you to just share with the audience a little bit about what that is and what you do.
Sure. So just to give the audience, a little bit of a background, what a CBO is, or a Chief Business Officer. All companies don't necessarily have these named officers, so to speak. But really, at the end of the day, what their job is to solidify business development partnerships, whether that's through sales, royalties, milestones, et cetera. But it's really connecting the company that one works with or for, approaching other companies for partnerships. For example, in pharmaceuticals, a typical role of a chief business officer would be to, within business development, would be to explore different assets that one company has and try to partner them or marry them with other companies. That could take the form of divestitures, it could take the form of investment, or it could take the form of negotiating various deal structures, in the realm of milestones, royalties, and that kind of thing. Once a product within the pharmaceutical company would actually be approved.
Got it. Okay, great. So going back to the starting point for you, you got your PhD. I mean, I'm sure it started before that, but tell us a little bit about that journey. What made you go down that path? Did you want to be a doctor to begin with?
Right. So back when I did my PhD, I did it in neuroscience, actually. I had full intentions of becoming a professor. But then I very quickly realized during my PhD itself and exploring various career options for PhDs, I realized that first and foremost, the lifestyle of a professor didn't really match my personality, number one. But also, number two, I became very excited by the business aspects within science, which at the time, 20 or so years ago, I didn't fully appreciate existed. So it was through that journey that I ultimately, like you mentioned, I did an MBA while working full time, and then saw just how valuable the skill set of a PhD and MBA could actually be. And I've used my skills ever since. And for skills that the MBA or PhD don't teach, it's really like any other career path. It's really learning the skills on the job.
So, David, talk a bit about the journey to where you are today. You've had quite a varied career from working in pharma initially. I think you've stuck around mostly in the life sciences space, but you've also worked in banking as a research analyst. Share a little bit about that journey and what it's kind of how it set you up for what you do today.
Thanks, David. So to your point, I mean, my career has been very interesting and varied in the sense I've liked to think outside the box. Just like I did the PhD MBA, which at the time wasn't very common at all. Now it's much more common. But my career, I started in pharmaceuticals and biotechnology. I worked with Fortune 500 and in some cases Fortune 100 companies, which your viewers will know for sure. And I did that for about 10 years until I was poached over to go to capital markets. And on the pharmaceutical side, I focused mainly in business development, sales and marketing, and a little bit of medical affairs as well. When I was poached to go into capital markets and to lead biotechnology franchises, I didn't know a lot about what that even entailed, but being the very opportunistic individual that I am and doing a lot of due diligence as to what that was, it was probably one of the best decisions I could have made for my career. Because what I was really doing was I was taking, on the one hand, experience I gained from working at the issuers themselves, so whether they be public or private. I started my career at Johnson & Johnson. ended at Alexion Pharmaceuticals just before the big AstraZeneca acquisition. So I knew working at the issuer how issuers behave internally and what they're hoping from investors and the outside world. When I combined that by going into finance and capital markets, I was able to use those skills in my role as equity research analyst and as well as investment banker um, to really understand back from a different perspective what the issuer was going to be looking for. So it's a very unique skill set that very few individuals have. For sure, in Canada, in the U.S., it's a bit more prevalent, although it still isn't a skill set I would say that a lot of folks have, and in large part because of the journey or the time that's required. I mean, this was probably a little over 20-ish years in the making. And so now, it's serving me very well that I've been able to marry those two skill sets together. And just to your point, with some of the companies that I'm working with now, some of which David, you've been kindly, to set me up with, those opportunities really wouldn't have been possible whether it's acting as chief financial officer or chief business officer. Um, I wouldn't be able to do those jobs effectively as I am right now without having the two types of skill sets, working both within finance and the capital markets, but then also having a vast and deep experience in working with issuers.
And then the science component in this space, obviously a unique one. How much has that helped you in understanding the science behind the products that your companies bring to market?
Yeah, it's funny because my PhD itself was in neuroscience, and I haven't really worked in the field of neuroscience directly before, but many of the companies I covered, as head of biotech and life sciences research, a lot of those companies drew upon my the neuroscience type skill set. But that said, what I would say is that it's very much a transferable skill set. If one can master the area, whether it's neuroscience or whatever science it is, the skills to learn within finance and how you apply that within finance, while at the same time tapping your scientific skill set, I mean that's the name of the game. So if you can master one area, then I think it would be much easier down the road to master another. But the science, I don't want to downplay it at all, because at the end of the day, throughout my time in capital markets and finance, and to this day, it's all been within life sciences. That's what I've dedicated my career within is life sciences. So the science background definitely helps. And it also very much helps just from a credibility perspective, because at the end of the day, CEOs of whether they're small, medium, or large companies want to know that the person they bring in, whether it's in a fractional nature, as a CFO or CBO, and or as a equity research analyst covering life sciences companies, those CEOs want to know that those individuals speaking on behalf of the company, or in some cases for the company, are credible enough to do so, and that really comes through, some of the not only the experiences but some of the educational pursuits I've been fortunate enough to have.
Yeah, it's a great call out. I think the definitions we use of, what is the CFO? There are a lot of different types of CFOs and profiles of CFOs. I really love the positioning of someone like yourself in many settings where companies tend to generalize their needs and think CFO is all things. Whether it's the financial reporting, the capital market savvy, and all of the things that companies need to do from a finance perspective. But most CFOs that come from a typical Big Four financial reporting traditional path don't have the understanding and experience that you're bringing. And so, talk a little bit about that. Your type of situation where you as a CFO would be a really good fit, and not to be self-serving, but for folks to understand the profile of the CFO that you represent.
So I think the nature and the roles and the function of the CFO is ever evolving. Historically, to your point, you had to work with one of the big four firms, have an accounting degree, which I don't have, in order to be a CFO. I think the game has changed tremendously, especially in the U.S., which is where I do a lot of my business with companies. A big part of my background with that, the fact that I was in the capital markets and finance, lets me speak the language of a CFO, because at the end of the day, in large part, that's what a research analyst is doing. At least one component of the job of a research analyst is understanding the financial reporting standards, financial statements, whether that's through IFRS, GAAP, whatever the reporter might be, whether it's in Canada on the TSX, or in the US, NASDAQ, or NYSE. What I find a lot of CFOs lack in my direct experience within the capital markets is being outwardly focused. And what I mean by that is a big part of the CEO's job and the CFO's job is to be facing investors or potential investors. A lot of CFOs, know the numbers inside and out, but don't know how to properly communicate that so it speaks in a more positive light for the company. And I'm not saying spinning any type of information. All I mean is being able to look at various metrics. And one example in particular, a company I was involved with was looking at cost of revenue versus COGS, or cost of goods sold. And the difference between those two could make a very big difference in the investor's eyes with how the company is actually reporting. And I was the first to notice that within the reporting standards of this company. And we changed it ultimately because it reflected better on the company. So what I would say is that with a person, not just me specifically, but a person with my type of a background, having that issuer experience plus finance, excluding the PhD or the MBA, I think that gives companies a real solid advantage when speaking to both current and potential investors, because the analyst, if one has done the analyst or investment banker job, you actually know what the investors are looking for because you speak with them on a daily basis. So being able to communicate in their language, as opposed to a numbers only type of a CFO, which is historically I would say the maybe more generic stereotype that CFOs have, that would set a company apart in many circumstances. Not all. There are very numerous companies that could in fact rely on a CFO that is only numbers focused, that doesn't need investment, that has other individuals that can speak with investors. And for those companies, that's great. But I would say the vast majority of companies, especially in this small and medium range, could benefit from CFOs who can both speak the language of investors, but also of a more traditional CFO.
Yeah, that's fantastic. And the other thing you bring is the commercial experience and capabilities. And so, talk about that, the sort of upside that comes from understanding what go to market. You've got the biz dev, you've got the corp dev, and the sales and marketing. I think you started your career in that realm. So talk about how that helps you perform from a CFO CBO perspective.
Yeah, that's a great question. And that's where I would say is more the CBO role, the chief business officer role. And in fact, in some cases, companies might decide to make the two roles synonymous or together. So a chief financial officer and a chief business officer with the role rolled into to one. What I would say from the launch or commercial perspective that really helps. So I started my career not in biotech. I started my career in pharmaceuticals. And that's really all commercial. When you think about, a fully integrated pharmaceutical company, which is essentially where I worked. I was part of launch teams that launched drugs, in fact, rare disease drugs as well, throughout North America and other parts of the world, which is no easy feat. So having that experience from these pharmaceutical companies, with very big pharmaceutical companies at the time, really helps me a lot now because I'm more focused on biotechnology now, as opposed to pharma. So when you think of biotech, you think of R&D, phase one, phase two, maybe going to phase three, looking to partner drugs. So it really helps me understand now, as part of a launch or former launch teams, when we're looking to launch drugs and commercialize products, how should the biotech companies that I'm working with now, how should they position themselves to be able to compete effectively down the road once they're actually in a position to commercialize product.
So as you're saying that, I think for our broader audience, it's probably helpful to break down, we use these terms, under life sciences, you got the pharma, biotech, quick description of what the difference is and how the business models look different, which you alluded to, but just maybe a quick definition would be helpful.
Sure. So I think it's easier for your audience maybe to grasp what pharmaceutical companies are first, because it's what we see more, in day to day news. With the Mercks of the world, with the Pfizer's of the world. Those are more pharmaceutical companies in the sense, yeah, they do R&D, but they also commercialize and sell. Whether it's their own products or other people's products. So in other words, they're revenue generating in most cases. Biotechnology, for the most part, there would be some exceptions, but for the most part, is non-revenue generating. So what biotech is doing is generating R&D, generating the assets, and ultimately putting them through phase 1, mostly phase 2. But then once you get to phase 3, which is the final phase before, say the FDA will come in, or Health Canada, or the EMA. This is where biotech companies will look to exit, typically through an acquisition to big pharma. So you think of the pharmaceutical companies being, having a much larger cash position, in large part too because they're generating sales, but looking also to acquire the smaller biotechs as well.
So the small molecule versus large molecule, like the whole historic kind of definition of what a biotech versus traditional pharma, that's sort of gone away. Like pharma companies now, for all intents and purposes, are biotech companies as well, and they acquire biotechnology product. Is that fair to say?
I think it's fair to say that a big part of the pharma model now, instead of developing in-house molecules, whether it's small molecule or large molecule, they're looking to biotechs. There's been many acquisitions over 2024 alone. Just one a couple of weeks ago out of San Diego, California, one that I followed closely, called Longboard Pharmaceuticals, with a major acquisition by Lundbeck, a Danish company. But at the same time, pharmaceutical companies, in addition to acquiring the smaller biotechs, they also have an in-house R&D team. But I think over the last, call it 10 to 15 years, the acquisitions across the pharmaceutical and biotech space have only increased because big pharmas are finding that it's although still expensive, it's still a lot cheaper to acquire the biotech itself than to develop it and see it through to phase 3 and full regulatory approval in-house.
What would be great to hear from you, David, is on this topic, the sort of life cycle of, a biotech. Someone has an idea, an aha moment in the middle of the night, or, maybe in a lab, um, and how they get to a place where they're getting into, clinical trials, phase 1, phase 2, etc. At what stage would engaging someone like yourself, make sense? So, in both walking through that sort of life cycle, and then at what points might they want to pick up the phone to call someone like you for some advice?
Yeah, sure. So I think, back to biotechs, we'll ignore pharma for a second, what the life cycle looks like if you're developing R&D or assets within your R&D team, and just focus on biotech. So if you're looking for a biotech, even if you don't have an asset right now, I think if you're looking to acquire an asset or in-license an asset, for somebody with my specific skill set within the CFO and CBO realm, I think now would be a great time to engage someone like me, up to and including all the way up to phase 3, when you're looking to partner an asset. And the reasons are severalfold, and I'll go through them quickly here. But the first is, if you're in a position and you're currently, if the company's in a position looking to explore an acquisition, whether it's a new asset or an existing asset through a university, the company itself likely doesn't have access to capital, or doesn't have a lot of capital right now. So a big part of what I do is capital formation and helping companies raise capital. Just having relationships, not only relationships, across North America and Europe, but knowing which specific funds would like different types of companies. So first and foremost, I think for a CFO or CBO role to get in front of investors at the very earliest stages is absolutely important. And then going through up to phase 2 and phase 3, that's where the biotech is likely still going to need a CFO and or a CBO to get in front of investors. But also as the asset matures and it becomes more successful across its clinical trials, what it's going to need is an effective business development person or chief business officer to effectively negotiate what the rights are going to look like with other pharmaceutical or even other biotechnology companies for future uses of that asset. So the life cycle could look like anywhere, call it 1 to 8 to maybe 10 years for a biotech. But that's being oversimplistic. It's much more specific to the actual company. And, for as many biotechs as we've seen succeed, there's been a lot that unfortunately haven't succeeded just due to a lack of capital. And this is where, being a company focused in the US, I find is much more helpful than being in Canada right now. Canada produces great science. Unfortunately, we don't produce great companies, with a few exceptions, of course. But if any company, Canadian included, is looking, for access to capital and other markets with other investors, other exchanges, I think there's no better place to be than the U.S.
Yeah, so that's a great point as well, which is access to capital. What's the current state of the market, would you say, when it comes to that? Is it similar to the broader investor, whether it's private equity or venture capital? A lot of money still on the sidelines, really challenging environment to raise money. Is that starting to loosen up? Has there been some success in that regard? What are you seeing in the market today?
Still a very tough market out there, without question. That said, there is access to capital and tough environment to raise capital. You have to think about the macro environment too. So even if the macro environment isn't fantastic, then it becomes more difficult to raise capital. And this is where investment banks come in, not so much venture capital or private equity. Private equity would more focus on revenue generating companies. They're not so into biotechnology companies, which are non-revenue generating. But this is where investment banks come in and will impose fairly, common but almost punitive structures. And by that, I mean, adding warrant coverage to any particular deal, which companies don't like to do necessarily. But the funds or the buy side that will come in to fund a deal, this is their bread and butter because it allows them to not only make money in the short term, but if you have, say, a tranched warrant structure, which allows investors to cash in over a period of time, assuming the company performs, it allows the company to keep the lights on, and it also allows the investor to make money along the way. That said, we do think, over the next few months, the markets are going to get quite a bit better, and that will be more favorable from life sciences. When you look at some of the major indices, like the XBI, it's up around 12 to 15% on the year. But these fluctuations, can change on a dime just by the nature of biotech, where you see some valuations and how they can change very quickly and not even necessarily based on anything inherent within their company or assets, but just on the basis of overall market sentiment on a very broad level.
So are you telling CEOs today to wait till the markets open up, to hunker down? Like, what is the advice you're giving them, and what would you say the hardest part of what they're trying to do is? Because it's definitely not easy. Capital raising, is that the hardest part? What are some of the other things that you're seeing as far as obstacles that you can impart some advice and wisdom on?
That's a good question. I think first and foremost, my biggest piece of advice to CEOs is always raise money when you don't need to raise money. The moment the market senses a company needs to raise money, A lot of folks, unfortunately, will short stocks, a practice I don't think is right, morally or otherwise. But unfortunately, it is legal, and a lot of folks will do this. So always raise money when you don't need to, in large part because you're going to get more favorable terms, and there's not going to be a financing overhang over the stock. The other piece of advice to CEOs is, I know when they see some price tags with various talented individuals, especially in Canada, you know, they don't understand the value that various individuals bring, whether it's a CFO or a CBO, and then sometimes it's not tangible, at least in the very near term. But I can't stress the importance of having qualified and reputable individuals to get in front, especially if you're trying to raise capital, get in front of potential investors so they can actually speak the language of the investors. Because in large part, the CEO, and again, there are exceptions, but the CEO will be talking about their vision and more higher level components here, which is great. But at the end of the day, the buy side wants to hear more, something a bit more tangible, market dynamics, and things that are more specific to how the company will actually perform. The third piece of advice I can impose on CEOs is don't underestimate the US markets. I know some folks are maybe opposed to US markets, maybe because some of the exchanges are very expensive to operate on. But in my experience, the access to capital and what that affords with valuations will really allow companies, assuming you have a good asset and a good team to drive it forward, to really increase valuations. Because at the end of the day, when you compare the U.S. and Canada, Canada is good for certain things, but there are a few different firms that stand out with being leaders here in Canada. Bloom Burton is a great example of being a market leader in Canada. But there's only one Bloom Burton in Canada. And to some extent, they draw a lot on US folks. So this is where, as I'm further developing my career, I'm looking more and more to the US all the time, whether that's for US issuers, which is true, but also for US investment banks as well.
Yeah, I think the US piece is really interesting. I've heard, you know, generally folks want to bring people onto their teams that know the U.S. market, have the connections, whether it's a Rolodex or just the wherewithal to navigate the market. What's your take on that? Is there a lack of talent here that has that ability? You certainly do, and have spent a lot of time focused on the U.S. market. But is that a gap you would say in the market here, and folks really need to go south of the border to find that talent?
Well, I mean, it really it's a good question, David. It's a complicated one to answer too, because I think talent exists everywhere. There's a lot of really like stellar talent in Canada, without question. I think it's a matter of for the CEOs of companies and even just maybe chairmen or chair people of company that are founding companies, be very specific with the skill set you want. And in many cases, that talent's going to exist in Canada. In other cases, it's going to exist in the U.S. The beauty now, in our post-COVID world, is a lot of these operations within a business, investment banks. It's all virtual, so it doesn't actually matter if you sit in Canada or the U.S. But as long as you understand the nuances of each market, if you have good relationships in each market or whichever market the company needs to focus on, I think that's what's important. And that's where coming to a company like you, David, with CFO Hive, your mandate is to understand the talent out there and how different, whether it's CFOs or CBOs, can help different companies in navigating the complexities of the current business environment. So, nobody can be everything to everybody, and that's where networking helps. That's where talking to the right people like you, David, and CFO Hive will really help to hone in on the right skill set and the talent out there that's available.
Yeah, it's a good point, and one that, of course, I agree with. I think on the fractional world, like we talked about some of the contract opportunities that we've partnered on together and continue to. That's sort of an evolving space. And when I hear you say that there's this hesitation on the part of CEOs to make the investment for the right talent and get scared of this sort of price tag uh, of some of these individuals, uh, I wonder what your thoughts are around sort of the evolution of the fractional space, which allows them to kind of access it on an as needed basis, get their kind of feet in, and not necessarily have to make this huge commitment. And perhaps they grow over time and get to know each other, and it's early on, just a light touch engagement, but then over time, you get to know each other and maybe make a full time commitment. Do you think that that's changed significantly in the market?
Well, I think now fractional individuals, whether they're CFOs or CBOs or various other roles, with maybe the exception of the CEO, I think those have definitely increased traction over the last few years. And it's really because you're getting access to talent who can help you. Yeah, maybe on a prorated amount, is the same as what a full time CFO or CBO would charge, but you're getting them for a fraction of the time, which is hence the word fractional. Um, I do think there's positives and negatives for any company to hire fractional. The positive being, yeah, you're going to save capital for sure. That's the first one. The second positive is that you get to kind of try each other out. The fractional CFO gets to see, is this a company? Are these people, he or she wants to work with, and vice versa for the CEO. On the other hand, some of the negatives, and they're not so much negatives, it's just maybe more on the downside, because the fractional CFO typically has a number of companies he or she is committed to. They don't necessarily have the full day to commit to the other company. So there's that give and take, which is where sometimes the full skill sets isn't necessarily realized between the fractional CFO and the CEO, not because the skills don't exist, but because the time isn't there for the actual individual who's fractional to commit 100% of their time to the CEO. But those are kinks, I think, that can be worked out in time. And especially when you're talking about the more outwardly facing CFO, as opposed to the sole number driven CFO, which again is very important. That's when I think the distinction will really come through. Because, look, at the end of the day, I know you're an accountant, so no disrespect to accountants. Accountants, just like lawyers, are to some extent, a dime a dozen. But the right accountant, the right lawyer, with the right experience, with credentials aside, I mean, that's when, it's hard to put a price tag on something like that. If you're talking about companies that are eventually going to be sold, within the seven figure.
Yeah, I think that was a compliment. You started out saying you're apologizing for, maybe disparaging accountants, which I thought we're going to edit this out, but I think that turned into a good point on behalf of the ones
That's good.
that,
It
can
was
make
not
it.
meant to be
Yeah,
disparaging.
yeah, it
Um,
wasn't at all. When you talk about the downside or the risks of not being fully there for a company. I also think everyone's got a different stage, and there's ebbs and flows to that. So managing that could be really challenging. And some of these companies are going to make it, some aren't. And so the ones that make it and say, okay, I want to take you from a day a week to 2 days a week or to 3 days a week, or how do you balance all of that? I think that makes it really challenging, particularly in this space. But I suspect when there's an event, a transaction, whether it's going public or capital raising, it gets more intensive, and you need to plan for that. On that note, can you talk through a bit of a transaction that makes it a little bit more real for someone? You don't have to use names, but maybe share a bit of a story, a success story, or it could be a failure, whatever you want to share. But this walks through a little bit of the anatomy of a deal.
Yeah, that's a really good question. I would go back a step to say it's always good for companies to raise money when they don't have to raise money.
Yeah.
At one time, a 12-month runway for a biotech was considered good. Now I would call it, 18 to 24 months is a good runway. So, I think a transaction can occur in a multitude of ways. You want to hear about how the issuer would approach it, but I also just want to focus quickly on how a bank would approach it, because an investment bank that has a relationship with a company that I've seen many times comes directly to the company without the company even asking for this. And these would be public companies now, not private companies, but would say, hey, to the CEO, CFO at that level, we have X, Y, and Z investors who want to make a deal to you for X number of dollars at these terms. That would be one scenario where the company doesn't actually do anything, which is, I would say, still common among investment banks. The other example, which I think you're hinting towards, is where what does the life cycle look like from a company? The life cycle can look, call it anywhere from a month to upwards of 12 months, depending on how aggressive the company wants to be. So an example for an issue we're looking to raise capital, one that I was directly involved with, was just given my background and relationships I had from within finance and capital markets. I did help a company, source, you'll say in the millions of dollars, just based from another strategic partnership. Now, while most individuals think, you need the investment bank or a family office to help you source capital, in this case, it was coming directly from a strategic partner. I think CEOs shouldn't underscore the importance of whether strategic partners in the sense that you have a current deal or negotiation ongoing with them, or you just have a relationship, which I did. So this was able to help the company, in their growth prospects. So again, I'm trying to distinguish between the traditional investment bank, which is a process as well, but then from a strategic partner. And I think the two processes would be very different. The one thing I would just caution CEOs on, if it's a very well-known fact that the company needs to raise capital, and when I say well-known fact, I mean just by whether it's on SEC filings, on Edgar, whether it's on CDAR, whatever it is, if that investment bank and others know that a company is out there trying to raise capital or will try to raise capital, the CEO and the CFO should be very or be paying very close attention to which accounts they're going to be meeting with, because while it's not, I wouldn't say it's the norm by any means, but it is still possible for the investment bank, while they're trying to help the actual company through no fault of their own, kind of tips off one account that the company will meet with, and then you see a drastically lower share price, in large part because one of the accounts is trying to short your stock, which is something we touched upon earlier. So there's an art to it. It's not just about going to market, get all the money you can. There's an art to it too, where you have to be very nuanced and almost subtle in the way you approach things, especially within the U.S. and finance and capital markets.
Yeah, I suspect that only comes with having gone through it, but you having been in those different seats. Can you talk a little bit about investment banks and how they play a role in this process? We've touched on them a little bit, but I think it's somewhat little understood, the world of investment bankers, especially for those that have yet to engage.
Sure. So, I mean, let's take a step back and just describe what a full service investment bank would be. Typically, that would include the investment banking department. That would include research. That's where I was in, as well as banking. That would include equity sales and trading. Okay, that on its face is the most basic a full service investment bank could get. So sales and trading mean selling the stock and then trading a stock. You could have investment banks focusing more on retail clients or institutional clients. For larger market cap type companies, that's where institutional is. Well, institutional is always preferred over retail, I would say, for at least within the biotechnology community, because they tend to be not in all cases, but in most cases more educated. But within the investment bank itself, when a company is trying to source capital, the first conduits within their journey is going to be the investment banker. The investment banker will then like to do a lot of due diligence, probably put them in touch with, a research analyst to get their expert opinion on it. And there's a so-called Chinese wall. At least in the US, it's much more strict than in Canada, but the banker and the analyst will seldom speak with each other. In Canada, the laws are a bit more lax. But at least the banker will want to, on almost a no names basis, will like to see what an analyst thinks of the actual company from a scientific perspective, not for necessarily from a valuation perspective, but from a scientific perspective. Then, if the company's successful in raising capital through investors, then the investment bank or banks will be selling and trading that stock, and just based on whether it's press releases, news, expected catalysts that are coming, analyst reports. Analyst reports go a long way in helping to support or not a stock, depending on what the analyst actually thinks. So from that perspective, investment banks are very important to any public company. Private companies, if you're looking to go public, an investment bank will also be important as well. But I would say from a public company perspective, a big part of what I do every day is speaking with bankers, speaking with analysts, speaking with sales and traders, and investors as well. So this is where the CFO and CBO role comes in when we're talking about the outwardly facing capabilities of one. This is in large part what I do.
And maybe a good segue to talking about one of those investment banks. We're both big fans of Bloom Burton. You mentioned them earlier. Great team, great people, and the ecosystem that has grown in the Canadian market. And I feel like every time we go to that annual Bloom Burton conference, you see the growth and the um, size and robustness of the ecosystem, and really a lot of I'd say North American and probably global players that come up to Canada. I don't know if it just feels bigger and stronger than it really is, but can you share a little bit about your experience and just having been in this space for so long and where you see the ecosystem today? Is Canada punching above its weight? And maybe you could talk a bit about Bloomberg and their influence on that as well.
I mean, the Canadian, maybe not even, I'll take a step back, not the Canadian ecosystem, but the Ontario ecosystem, is strong for sure. Where I think the Canadians compete are more on the science at the R&D level. Company formation, you'll have a handful of companies that have done very well and that are doing very well. At the Bloom Burton Gala that we were just at, David, we saw with Roberto Bellini winning a very impressive award there as voted by his peers. Since I've been involved in healthcare and life sciences for the past 20 years or so, it's incredible how much it's involved. And Bloom Burton has been instrumental in making it happen. Kudos to them, for taking that risk and building a firm like this and seeing where it's grown to. I mean, at the award venue itself that we saw a little while ago, and even at the annual conference, there's an ever-growing. At least to me, it seems. I can't speak on behalf of Bloom Burton. I'm simply I would say maybe a patron of the firm or a friend of the firm. I have noticed in large part a growing influx of Americans to every event here, and that goes back to where I think a lot of the institutional money is in the U.S., not so much in Canada. And this is where kudos to the likes of Bloom Burton and others. There's other firms as well, not nearly as big. I was a part of one. We had a group like myself, and I was head of the life sciences equity research area, but we were not as big, obviously, as Bloom Burton. And having those very close relationships in the U.S. certainly helps a lot. So it's been great to see the evolution of the Ontario and in some cases the Canadian biotech system. But I've really decided to shift my sights more so on the U.S. now, just because I see through direct experience just how big it is and the potential to really generate meaningful stocks here. But again, I think the Canadian system has been crucial in the sense of the assets themselves from an R&D perspective being developed in Canada. In fact, a number of companies I'm involved with now, one in particular, um, at least one of its assets was actually in licensed through an organization in Canada.
I guess on that note, what do you like now in the market? What are hot spaces that, when the phone rings and someone's asking for your help, you get, really pumped up about where's that trend?
What gets me really excited, first and foremost, is actually the team that I'm getting involved with. The science is obviously right up there, but I was always taught early on in my career, it's better to work with a stellar team and a mediocre product than a mediocre team and a stellar product. Because rely on your team to get the necessary, whether it's capital raising or regulatory submissions or sales and marketing, whatever it is. So the first thing I'll do is go and look at the team who's involved, and if that gets me excited, then I'll do a deeper dive on the actual science. There's so many different areas now in biotech that are really just exploding. Not so much from on the molecular level that we need to talk about today, but just more on a therapeutic area level. Oncology is a very big area. Pain is looking, it's one of those nebulous areas for the last few years, but is looking more and more tangible now. So that gets me excited. And various neurology disorders get me excited as well. And also within the rare disease space in neurology. So I say when I have to do due diligence on a company, which is very regularly, if I can check all those three boxes, I get excited, then we're definitely going to move to a first or in some cases a second call.
So, David, what else would you like to share with the audience, perhaps that we haven't brought up? Any sort of wisdom or guidance or insights that you'd like to share?
Look, I think people like you, David, they're running companies, CFO, Hive, bring a lot to the table here. Number one, it just demonstrates your own entrepreneurial mindset and ability, but also it allows CEOs and founders of companies to actually go directly to like you, because you have a vast network, a deep network of talented individuals you can bring to the table. So my message is, you don't have to come to me directly. Go through CFO Hive and others to see what type of talent they bring to the table. I think the other component is for interested parties out there, don't underestimate not just experience itself, but how one has married that experience. And for me, in the case of over 20 years of life sciences and pharma biotech experience, all focused, whether it be from the issuer side and then finance. Something like that is in my opinion, is such a gem and such a rare find, where it's not, and that's almost a double-edged sword to me, in the sense I don't fit the typical profile, where I'm not necessarily checking the standard boxes that folks are going to like. But once you dive deeper into the actual experience that I would bring, that's where I think I have had very few calls that have resulted in no business from something like that. So my message, that's a long way of saying for the founders and CEOs and others to take the time to get to know the actual individual, and don't just, to your earlier point, don't just look for that CFO with kind of experience from a top four accounting firm, because there's a lot of especially in the US, it's much more common for analysts to become CFOs of companies, and then you add the CBO on top of that, and it's just a skill set, something that would add a lot of value to a lot of companies, in particular small and medium size.
David, I will say you are truly an N of one, and we could talk all we want about it, but I've seen it firsthand more than one occasion, and so kudos to you for everything you've done and for how you're going to market to help these businesses now. And so I'm a huge fan. That's why it's been an honor to have you on this podcast and to work with you. And I look forward to continuing to do so and hopefully having you back on here again sometime. So thanks so much for doing this.
Thanks, David. Been a pleasure.